You're going to record. So, welcome everybody. I know we have some Valuation Masterclass Bootcamp students. There's Lee Rigglesworth. Good to see you. One of the Valuation Masterclass graduates. Other people that are in this group, some of them are current Valuation Masterclass Bootcamp students, and some are prior students. So, welcome to everybody. And I'm going to get started. We're going to be talking about 9 valuation mistakes. I'm going to go through it fast and hard. So feel free to leave a message or a question in the chat. So let's get started. I'm going to share my screen and let's do this. So this presentation is called 9 Valuation Mistakes and How to Avoid Them. Just a little background on me. I grew up in the U.S. I did my undergrad in finance. I did an MBA, and then I did a PhD in finance in 2016. I went to work as a supervisor at Pepsi. That's me in the middle on one of my last days at Pepsi because I moved to Thailand from Los Angeles in 1992. And I went to Thailand to teach finance. I really didn't know much about finance. I just studied it at university. And I haven't left for 30 years. I've been in Thailand and I've been teaching finance. Now, I became a financial analyst. That's me when I had a little bit more hair in 1993. And I worked for 20 years as an analyst and a head of research. And then I was head of research at CLSA and was voted #1 analyst in Thailand back then when I was working in that field at 2008 and 2009. I was a 2-term president of CFA Society, and for those people that aren't involved in CFA, I highly recommend it. It really, really, really changed my life. I wrote 5 books, which you can find on Amazon, and I've created 7 online courses. Become a great presenter and increase your influence. This takes everything I've learned from presenting all of my life. Another one is called Achieve Your Goals. And in this one, I work to help people figure out what are their goals and how do they make sure they achieve them. The other one's called FVMR Investing, about quantamental investing across the world. I wrote a book called Transform Your Business with Dr. Deming's 14 Points, and that book is about that. And I wrote also a course called Finance Made Ridiculously Simple. And then I have a course called How to Start Building Your Wealth, Investing in the Stock Market. And finally, there is the Valuation Masterclass. I've found that I really enjoy making courses, the videos, the engagement with the students. It's much more interesting to me than doing books, actually. Books are kind of tedious to do, and you don't get that response that you do with an online course. Now, I've created 2 membership groups. The first is the Achieve Your Goals membership group. And basically, it's an on-demand course and a live coaching that provides a shortcut to success in business. Generally, it's for CEOs or senior executives who really need a kick, both from me and other team members, but also that they really want to push themselves to the next level. We meet every Friday. And then the next one is called the Best Business Book Club. We meet every Wednesday. That's me in my office where I am right now. Right now, we're working on the book called Never Split the Difference. And that's really a fun thing and a lot of learning. We read 1 book a month and discuss it every week. I'm also the host of 2 podcasts. This is my worst investment ever. And there I'm interviewing Rao Powell, the head of Real Vision. And I'm also the host of the Deming Institute podcast, and here we can see Dr. Deming's grandson, Kevin Cahill, and I'm interviewing him. I'm a full-time faculty member at Thammasat Business School, and I'm also a visiting faculty at Sasin School of Management here in Thailand, and recently have started at Chulalongkorn Business School, the Masters in Finance program, to talk about ethics there. In 2017, I moved my 2 decades of teaching valuation at university online, and I created the Valuation Masterclass long before we had the pandemic. And today's lecture is coming from mistakes that I made as an analyst, mistakes that my analysts made when I was head of research and I saw them, I oversaw their work. And the students that I've had more than 2,000 students enter the Valuation Masterclass. But recently, I really must say that I was a little bit frustrated with online courses. Basically, people that attend online courses, the statistics tell us that only 10% of people who attend online courses complete them. Think about that for a moment. That's kind of amazing. Everybody starts an online course and they think, I'm going to finish this, I'm going to learn. And I can see from my own statistics that only 10% completed it. And I felt like I wanted to do more. And that's the reason why I started the boot camp, because that allowed me to go from 10% to 70%. And that's how many people generally will pass the boot camp. And that's, I've found also that people really like, and I like, the interaction that we've got in the boot camp. So all of this I summarize in my book. Now you're going to get a video playback of this, so don't worry if I go a little bit fast. Oh, and one last thing, I live with my mom. There she is in beautiful Bangkok. So ask your questions. It's fun. Just ask them in the chat. I would be curious to hear what kind of questions that you have. So here are the 9 mistakes. Number 1, overly optimistic revenue forecast. Number 2, underestimating expenses, causing unrealistic profit. Number 3 is growing fixed assets slower than revenue. Number 4 is confusing CapEx with maintenance CapEx, growth CapEx with maintenance CapEx. Number 5 is forecasting drastic changes in the cash conversion cycle. And number 6, I'm going to move my desk up here. Number 6 is underestimating working capital investment. Number 7 is valuing a stock using the calculated beta. Number 8 is choosing an unrealistic cost of equity. And number 9 is not properly fading the return on invested capital. And I was just talking to someone about this in the professional space, that they weren't doing that properly. But here you can see that the top 6 of them really are about forecasting. And so I've really learned about valuation is that most of it's about forecasting, and then there's a small amount related to valuation. So if your forecast deviates significantly from the past or from consensus, you want to ensure that you're not making a common mistake. If you're not, then you got a story to tell. And great stories make great analysts. That's the key. So many people come to me and they want to know the numbers and the ratios, but ultimately life is all about stories, and it's no different for being a great analyst. So what do you think is an accurate earnings forecast? Could be 1%, 10%, 20%. Well, over the past 15 years, across all countries, all sectors, all companies, analysts were wrong by about 22%. In the best year, they were wrong by only 4%, and in the worst year, they were wrong by 47%. They were always optimistically wrong. You can see that this red line is above the x-axis, meaning they were always optimistically wrong. But the key thing I want you to take away from this is what I say, yaw. When I say yaw, I mean you are always wrong. Once you understand that you're going to be wrong, then it tries to take the pressure off you to be perfect in your valuation and think about a range of value as a starting point. Now, all 9 valuation mistakes come from my experience as head of research and from students in the Valuation Masterclass. So what is the Valuation Masterclass? Well, we train world-class financial analysts and help them get a better job in finance. We start with Valuation Masterclass Foundation. That's self-paced and 100% online. We have 30 hours of lectures. Students value 4 companies. And then there's the boot camp. And the boot camp is an online 6-week boot camp, 3 to 4 hours a day, every day of the week. And it includes this Valuation Masterclass Foundation I just mentioned, plus additional practical assignments, live sessions like this one, team meetings, and then you write and present an equity research report. The next boot camp starts on July 25th. I know we're going to have some amazing graduates out of here that are listening, but I can't wait to get our new students in on July 25th. These are some of the graduates from the Valuation Masterclass Boot Camp. And for the members that are listening in that were in the boot camp, notice the picture of me up here in the upper left. You notice what's on top of my head? There's my hat. It is a boot camp. It's tough. So if you'd like to join the next boot camp, I have a special offer for you at the end of this presentation. So hang on and we'll get to that. But now let's talk about overly optimistic revenue forecasts. That is the first mistake that I've seen. And when I rank them by first, I'm saying it's one of the most common ones. So revenue is the starting point of business, really. Ultimately, you've got to get revenue, and it's got to grow. It's at the top of the P&L. It's called proof of concept, and revenue shows that the market wants your product and you can deliver it. So finance is both art and science. The science of finance is the theories and models that are taught in textbooks and that attempt to describe how things work in the world of finance. So some of these theories are arbitrage pricing theory, economic value added theory, modern portfolio theory, Modigliani and Miller theory of investment, the pecking order theory of capital structure, the prospect theory and rational expectations theory, signaling theory and capital structure. That's related to dividend payouts. All of these theories I've read and studied and learned about and teach about throughout my life in the world of finance. What about models? Well, we have a dividend discount model. We've got a Black-Scholes model. We've got the Fama-French factor model. We've got a Fed model. And we've got the Sharpe-Lintner capital asset pricing model. And then we have hypotheses. Efficient market hypothesis, expectations hypothesis, market timing hypothesis, random walk hypothesis. But the point is to understand the art aspect. Consider that business and finance are complex systems. They're impossible to consistently predict because of the interactions between competing forces, buyers and sellers, and humans and all of their strange minds and behaviors and all kinds of feedback loops. The market is very complex. So analyzing any part of that system does not necessarily give you an edge on predicting outcomes. So finance is both art and science. The last thing I would say about the science part is that all of these theories are just that. There are no laws. In the world of physics, in the world of engineering, there are in fact laws, mainly the law of gravity. But in finance, there are no theories. There are no laws. It's theories, models, and hypotheses. So nothing is set in stone in finance. Now, beginners in the world of finance, they try to use some sort of statistical tools to forecast revenue. Maybe they use linear regression or simple moving average. Or maybe they do a moving average exponential smooth where they're trying to apply a higher weight to recent periods. Or maybe an autoregressive integration moving average. And that's a moving average that allows for adjustments for like market trends and seasonal things and the like. But the question is, can statistical tools really help us when we forecast revenue? And I know for my students who are listening right now, you're also like, yeah, I need to know, how do I forecast this revenue? But imagine right here, if we were to look at the prior period, and I'm just going to look at this, this would have predicted that the next point would have been right here, but in fact it was there. And what if we go to the next one? What if we were to forecast, and I should have carried this out a little bit further, but let's just say we would have predicted that it was right here, but in fact it was right there. This is the revenue growth of all companies in the world. And here we can see that the same thing, by the time we get to the third one, we're down here. But in fact, if it got down here, the actual number came in here. And no matter how you slice it with linear or other types of regressions, what you'll find is that it's very difficult for statistical tools to help us. In fact, no statistical tool can accurately forecast revenue on a consistent basis. And that's why I say that finance is part art and part science. And a revenue forecast is always subjective. Remember, y'all, you are always wrong. Don't overcomplicate it. So curb your enthusiasm also, because you've seen that people have a positive bias. So good forecasting is based upon human judgment. There's many tools, but financial analysts rarely use these. I've, in fact, rarely seen an analyst use some sort of regression or even moving average for forecasting. This brings us back to complex systems. There's just too many unknowns that can impact a company's future revenue. Now, I want to tell you a story. This is my story of CoffeeWorks. I'm on the right, and my business partner Dale's on the left. And even though I have all the information in our business, it's still hard for me to consistently predict the revenue of our business. In fact, I'll tell you the revenue story of our business. From 1996 to 2003, it was our first years in operations making revenue, and we only were able to get to $600,000 in revenue. It was pretty depressing. Now, we had the 1997 crisis that happened in Thailand that depressed things really for about 3 years or 4 years, so that didn't help at the time. But then for the next 8 years, from 2004 to 2011, we managed to get our revenue up to 2.4 million. And then finally, for the next third 8 years, we got our revenue up to over $6 million. And now, of course, we had the pandemic and the crisis, but we're ready to fire off and make sure that we continue to grow this revenue. So let's talk about revenue forecast. It's the starting point for valuing a company. You want to keep revenue forecasting simple. It's just price times quantity. Now, revenue is best understood by getting out of your office and talking to the company, its customers, and its competitors. Now, in the Valuation Masterclass, we don't have as much time. It's not as easy to get out and talk to the company. So we go to their websites and we go to their annual reports and we go to their releases to learn. Now, to estimate a company's revenue, you want to study the following things. You want to study the industry, the company's marketing, the company's branding, the products and services, the selling process, delivery, and after-sales service. These are just some of the things that we would look at when we're trying to go through and understand what's the revenue going to be. Now, let's just talk briefly about the data. You've already seen the first chart of the data in this lecture. Our data set starts with about 55,000 companies. So we've been working for about 15 years on this data set. And so we've gotten pretty good on it. And we remove what are tiny and illiquid companies, which leaves us with listed and tradable companies, about 27,000 companies around the world. And then after that, we remove companies that have incomplete annual data, and that brings us down to 14,000. But we get even tougher because we want interim data, meaning half yearly or quarterly data, and that brings us down to 10,000 companies. In fact, a lot of those companies are in India where they don't have as great of disclosure on a quarterly basis as they do on an annual basis, which just makes it harder. For instance, they may not produce the balance sheet for quarterly numbers. So guidelines that you should consider. Our data set shows that the average annual revenue growth over the past 20 years was 6%. Think about that. Here is the data going back over all of these years, and we can see that 6% over 20 years. So if you're producing growth and you're a listed company and you're relatively mature, let's say, and you're producing growth above 6%, then you're doing very well. Now, the real estate sector is the fastest growing and the energy sector was the slowest. So you want to consider about global growth, you want to consider about sector growth, and then think about the historic growth of that company as you start to forecast it. Now, also, just to give you a little tip, make sure you're familiar with the rule of 72. That's where you divide 72 by the annual percent growth rate, let's say in this case 6%, to estimate how many years it will take to double. Now, you can see that it's going to be 12 years to double at 6%, 6 years to double at 12, 3 years to double at 24, 2 years to double at 36. That's the rule of 72. So this is how my Valuation Masterclass students avoid mistake number one. They understand the business and its revenue growth. This is when I taught the Valuation Masterclass in Malaysia. In fact, that was at the Securities Commission, the regulator in Malaysia. So how to avoid mistake number one? Theories, models, and hypotheses are the scientific part of finance. Your judgment is the art aspect. Keep the revenue forecasting simple, price times quantity, and get out of your office, talk to the company, its customers, and competitors, and review the company's past. Consider that the average global revenue growth of a large company listed in the market is 6%. And remember, you are always wrong. You want to curb your enthusiasm. Don't be overly optimistic. If your forecast deviates significantly from past or consensus, ensure that you're not making a common mistake. If you're not, well, you've got a story to tell. And great stories make great analysts. So let's move on to the next mistake. Gross margin. Gross profit is what's left after deducting from revenue all the costs related to creating the product or service. This is the gross profit margin, and in this case, that gross profit margin is about 29% annually. We also have the earnings before interest and tax margin, the EBIT margin, which has been about 10% of all companies in the world. And then we have the net profit margin, which has averaged about 6% over that 20-year period. This gives you some rule of thumb to understand the businesses that you are in. Now, it's a little bit of story time. Let's go back to CoffeeWorks and see what happened. Now, you can see there, this machine, this red machine that you can see on the left-hand side is our first roaster. We brought it in. We brought it into CoffeeWorks right here. We brought it in 1995. And here is that same roaster. We changed the painting of it. It's no longer red. And that roaster has been operating now for almost 30 years. And there's Dale, my business partner in CoffeeWorks. Now, let's look at the cost of goods sold. It's the green bean packed into bags and the labor that goes into filling those bags. So let's now look at the gross profit margin of my business, CoffeeWorks. And why do I mention about my business? Well, because I believe that what I've learned as an analyst, really so much of it comes from running my own business. Dale runs the business, but I take care of the accountings and finance. So now let's look at this for a moment. We can see our gross profit margin started, our gross profit rose to about 1.1 million and then eventually up to 2.7. Now, 2019, we made some adjustments in pricing and costing, but I believe that we now have gotten that back up in 2020, except for the fact that 2020 was a disaster, right, because of the pandemic. So here we can see that the average gross profit margin was about 29%, and it varied in a tight range between 28 and 30%. So analysts are often overly optimistic when forecasting a company's gross profit margin. And my point is it's damn hard to permanently increase gross profit margin. Even minor changes in gross profit margin can massively impact the company's net profit. So be very careful in your forecasting of that. Now, this is how my valuation masterclass students avoid mistake number 2. This one was a course that I did for the boot camp in Pacific City Club. And this guy is Professor Wasu, who's a really successful professor here in Thailand. This guy is got a great business in Thailand. He took the boot camp because he wanted to understand how to value his own business. So my students are cautious with changes in gross profit margin. So be cautious with these changes. Consider the global averages that I've shown you. And then focus your forecasting efforts on revenue and cost of goods sold, as these are the largest part. Remember, if gross profit is 29%, that means roughly 70% is gone with gross profit or with cost of goods sold. So focus on your revenue and your cost of goods sold. And remember to curb your enthusiasm when forecasting. Now, if your forecast deviates significantly from past or consensus, ensure that you're not making a common mistake. And if you're not, you've got a story to tell. And remember, great stories make great analysts. So let's go to number 3. So analysts often underestimate the growth in fixed assets required to grow revenue. But it's unrealistic to forecast a company to grow revenue without growing its assets. And underestimating growth in fixed assets results in an overestimation of free cash flow and hence value. So let me tell you a story. This is a story of what one analyst presented to me, and I just want to highlight the key of this story is this section right here, which I'm going to circle right here. This section, you can see that it went from 35 down to 5, and that caused a 76% jump in the free cash flow to the firm. What was that? That was CapEx. Now, why did the analyst do it? I asked the analyst, why did you do it? And he said, look, I was meeting with the company. This was back in, let's say, 2016. I was meeting with the company, and they gave me the guidance for 2017 CapEx, and it was $29 million. And then they gave me the guidance for 2018, and it was 32. And then they told me 2019 was 35. But when I asked them, well, what about 2020 and 2021? They said, we have no idea. That's hard to forecast in the future. So my analysts ended up putting in this $5 million. The problem with this is that it overstated the free cash flow of the firm. Look at the free cash flow. It was going, he forecasted 40, 46, 54, and then boom, 95, and then kept it at that high level. This would overstate the value of the business. So let's look at this in a little bit more detail. We can see it in a chart form, and when he did that forecast where he underestimated the CapEx, what happened was he should have had a line like that, but instead he had a line like that. And then when he valued the company, he was wrong. So this is what we decided to do is go back and look at the sales to asset ratio. So here you can see 400 divided by 290 gives us 138. Now I made it in percentage terms, so I multiply it times 100. You could also say 1.38, but I like to put it in percentage terms myself in this case. What does it mean? It means for every 100 in assets, they're generating 146 in revenue. So now let's look at this situation. And what we can see is that that asset turnover ratio starts to rise, rise, rise. And let's just look at it. There we have the asset turnover ratio over time. Now, if that asset turnover ratio is constantly rising, you have to ask the question, wait a minute, how are they going to go from 140 to 240 in revenue for assets that are in existence? And that's where you start to question and think about that asset sales to asset ratio. So basically, the asset turnover ratio is the ratio that I'm talking about. Here we can see the asset turnover ratio over time, and it's gone from 0.95 down to about 0.65 over time. Now, if the ratio is rising, it means that revenue growth is outpacing asset growth, meaning the company is getting more out of its assets. Fantastic. In fact, from a stock selection perspective, if you can find a company that's increasing its asset turnover, chances are you're going to have outperformance in that stock. Now, if this ratio is falling, the company is generating less revenue from its assets. So use this ratio to guide your forecasted revenue and asset growth. So this is how my students in the Valuation Masterclass avoid mistake number 3. They use the asset turnover ratio as a guide. Here's Nick Barton, one of our students, and Nick took this a while ago, and he was valuing his startup company. In this particular group, we had a lot of people from the investor relations community in it. So now this is what one of my connections at a big U.S. bank said about this particular student in the boot camp. His name is Bomb. He said to me, he's got all the tools to be really successful. I'm floating his resume internally and to my entire network on LinkedIn. So part of what I'm trying to do in the boot camp is help people get jobs. So how do you avoid mistake number 3? You use the asset turnover ratio to ensure that your asset forecasts are keeping pace with your revenue forecasts. And the rule of thumb is fixed asset growth should roughly match revenue growth. Now, if your forecast deviates significantly from past or consensus, ensure that you're not making a common mistake. If you're not, then you've got a story to tell, and great stories make great analysts. So the next one is number 4, and let's talk about accounting for fixed assets. Companies usually pay for fixed assets up front, but use those assets over many, many years. Accountants assign a yearly depreciation charge in the P&L to artificially spread the cost of that asset over its life. Now, the sum of these annual depreciation charges appears as accumulated depreciation on the balance sheet. And the net fixed asset value is gross fixed assets minus accumulated depreciation. Now, don't confuse gross CapEx with maintenance CapEx. Maintenance CapEx is what a company spends to maintain the productive capacity of existing assets. Imagine that you didn't expect that the revenue is going to grow much from your company. Then what you would say is we don't need to expand more equipment. We just need to maintain the existing equipment that we have. But growth CapEx occurs when a company buys new fixed assets. Now, I looked at the CapEx of all companies across the world and made this chart. And then I split it into growth and maintenance CapEx. And you can see that growth CapEx is the one that is much more volatile and can be cut. When people get scared or times are rough, you can see that they cut mainly this growth CapEx. So don't confuse these two. The rule of thumb is maintenance CapEx should generally match the current P&L depreciation charge. Many analysts miss this relationship between CapEx depreciation and sustainable growth. Now, I just want to mention a company, Fastenal. We talk about this company in the Valuation Masterclass Bootcamp. But let's just look at their numbers here. The key thing I want to show is the relationship between CapEx and depreciation, the red bars. And we can see that it's pretty much always above 1. That's what we've got. And there were some phases where it was much higher than 1 that tells us that they were going through a growth period at that time. Now, company guidance is just not enough. The best way to understand how to forecast CapEx for a given company is to ask the management. Management will usually give some guidance, but that guidance may only be for the next year or so. And for future years, you don't want to be like my analyst that turned in $5 million and $5 million for that. You want to try to match the revenue growth and the asset growth. And as an analyst, you have to make a prediction that this company is going to survive and they're going to continue to invest for future growth. Now, this is how, you like my beard? Wow, that's a big one. This is how my valuation masterclass students avoid risk number 4. They forecast CapEx at least at 100% of annual depreciation. So, when forecasting, consider both maintenance and growth CapEx. Maintenance CapEx should roughly match or be a bit more than the depreciation charge. And for growth firms, forecast total CapEx above 100% of yearly P&L depreciation. And for very high growth firms, CapEx could be much higher than yearly P&L depreciation charge. And for low or no growth firms, CapEx should be about equal to the yearly P&L depreciation charge. So if your forecast deviates significantly from past or consensus, ensure that you're not making a common mistake. And if you're not, then you've got a story to tell. And great stories make great analysts. Let's look at number 5. So, by the way, if you would like a cheat sheet for this with the 9 valuation mistakes and how to avoid them, just scan this QR code or go to the bit.ly link that you see on the right-hand side. Then you don't have to worry about taking too many notes. You can print out that cheat sheet, and from that cheat sheet, it shows everything that I'm talking about in this course. So let's talk about understanding working capital. The level of current assets and current liabilities is essential from a valuation perspective because it factors into this free cash flow valuation. So we have assets. The current assets are cash, accounts receivable, and inventory. And the 2 current liabilities are short-term borrowing and accounts payable. Now, there's 4 working capital efficiency measures. The inventory days is number 1. The receivable days is number 2. And the payable days is number 3. And the cash conversion cycle then is the result of these. It's the number of inventory days plus the number of receivable days minus the number of payable days. And the lower is generally better. Now, analysts often forecast unrealistic changes in the inventory conversion days, not realizing how hard it is to improve inventory management. So here I show the inventory days going back to 1995 up until 2020. And you can see that they're in a very tight range. Yes, there's an upward trend. There's more and more inventory, but it's not highly volatile. Here we can see receivables, which were a little bit more volatile. And here we can see payables also a little bit more volatile. And finally, the cash conversion cycle. It's not nearly as volatile as things like net profit. So here we got an idea of the fact that they're not that volatile, that red line. So let's look at the global averages. Inventory days about 57, receivables 64, payables 40, and cash conversion cycle about 82. So this is how my valuation masterclass students avoid mistake number 5. They focus on inventory and avoid large changes in working capital. This was me teaching in Beijing to a large audience of Chinese professionals. And take a note of the picture that I show up on the screen. Can you see that? It says constraints to growth. This is a picture that Alex made from my team. And Alex is a creative guy and my business partner. And try to see what he's showing in that picture. Can you see what he's showing? What he's showing is someone's hands bound. So Alex is a bit naughty there, I think, with that picture. But that was a fun one. I was at CFA Society Beijing. And again, one of the great things about CFA is you build a global network. So how do you avoid this mistake? Well, you focus on understanding inventory management because this is the core function of the management team. And you combine your knowledge of the company's history, industry averages, and the global average to forecast an appropriate cash conversion cycle. If your forecast deviates significantly from the past, you're probably making a common mistake. But if you're not, well, you've got a story to tell, and great stories make great analysts. So let's talk about number 6. Free cash flow working capital recognizes 2 types of investment. This basically is CapEx and change in net working capital. Net working capital is current assets minus current liabilities. Now, it's hard to forecast because the measure is a result of 5 separate forecasts. So you could fiddle around in a model for days trying to balance this. That's the current, under current assets, it's accounts receivable, inventory, and other current assets. And under current liabilities, it's accounts payable and other current liabilities. Now, when calculating net capital for the purposes of valuation, we exclude cash from the current assets and short-term borrowing from the current liabilities. So we can see here that working capital of companies globally, you can get a picture of it. The accounts receivable is about 12.9, and accounts payable, you can see down below on the liability side, is 8.6. So we take out the cash and we take out the overdrafts. You're looking at accounts receivable, inventories, and other current assets, and you're looking at accounts payable and other current liabilities. Now, we then calculate the change in net working capital, and if it's rising, it means more investment needs for the company, and it reduces the free cash flow of the firm value. Now, analysts often inflate the free cash flow to the firm value by underestimating these changes in net working capital. So let's look at that for a moment. Here we can see the changes to net working capital. I tried to make it as clear as I could. So what we can see is the accounts receivable, inventory, and other current assets here. And that gives us our I call it free cash flow current assets. It's not really something you're going to find in a book, but I just call it that because we know that this is excluding cash at this point. And we know on the liability side that we exclude debt. So we just have other payables and other current liabilities. And from this, we can see that the free cash flow working capital is 12 minus the 10, which gives us about 2. And then we can calculate the change. And in this case, you can see that the change is negative. That means it's an investment. As we expand, we have to invest in working capital. And here we can get a picture of what's happening over time. So the change in net working capital is small, but it's volatile. So I tried to show the CapEx, the level of investment. That's CapEx and change in free cash flow net working capital. And that net working capital could be positive or it could be negative. That is a volatile item. So let me tell you a story. In 1999, from the top of our Coffee Works factory here, that's what it looks like in there. And inside the factory, what I want to talk to you about is these bags of coffee right here. When we started our business, we thought that the big thing was to buy the machine, the roasting machine. So we bought the roasting machine, and then when it came time to sell to our customers, we asked our supplier, and we said, we want to buy coffee. And he said, how much green coffee do you want? And we said to him, how about 100 kilos? And he laughed and said, well, we only sell we only sell tons. And so I was like, oh, we don't have a lot of cash to buy the ton. But this is a working capital item, this inventory. And then I said, well, can you give us credit terms? That would be accounts payable. If he could give us credit terms, then that would help us. But he said, no, I don't give credit terms to new customers. So we had to take our cash and convert it into inventory and raw material inventory in this case. And you can see these bags are what remain of that initial kind of mistake. So this is how my Valuation Masterclass students avoid mistake number 6, and that is they look at past trends as a guide for net working capital. This was a class that we taught, the Valuation Masterclass at Phenomena here in Thailand. Now, in 2008, I was voted #1 analyst in Thailand, and at that time I had a lot more hair, as you can see. It took me 15 years after I set that goal that I finally reached that goal. So I lost, that means, for 14 consecutive years. But I created the Valuation Masterclass to help people become #1 faster than me. Recently, a graduate called me and said he had been voted #1. And he told me it didn't even take 4 years. So think of the change in net working capital as a small but volatile investment. Look at the company's historical trends as a guide for this net working capital and spend the time to review the outcome caused by your forecast of each different item and try to balance it out because you can really mess up your valuation. Now, if your forecast deviates significantly from past or consensus, ensure that you're not making a common mistake. And if you're not, well, you've got a story to tell. And great stories make great analysts. Let's talk about number 7. Let's talk about beta. Beta is a measure of the movement of a stock relative to the movement of the overall market. Now, companies with a beta greater than 1 they're basically moving more volatile. They move more than the market, and those with a beta of less than 1 are less volatile. Now, in the world of finance, we often call this risk, but it really isn't risk, it's volatility. Beta is a measure of relative volatility of that stock relative to the market. And in the theoretical world of finance, this volatility is called risk. But in the practical world, we call it volatility, or we call it opportunity to buy, sell, to buy low and to sell high. Now, what beta do you use? That's the question. How do you get it? The first challenge that an analyst faces with regards to beta is deciding on the time period and frequency of returns. These choices can lead to very different betas for the same company. Let me tell you a story. When I was head of research at CLSA, an analyst changed his recommendation from a sell to a buy. Now, this is a material change, so I spent some time talking with him about it. But when I looked into his model, I found that he only made one change. He decreased the beta from 2 to 1. Analysts often change beta to try to get to the value that they had in mind. It's not totally their fault. Here we have a calculation that I did of a beta of a company in Pakistan. I believe we have someone from Pakistan on the call. Adnan, I think, is here. But this is oil and gas development, and I went and looked at it to try to understand its beta. And what you can see here is that there was a period of time in 2014 where if you calculate the beta on a weekly or daily basis, you get 1.1, but if you calculate it on a monthly basis, you get 0.2. Here you can see so much volatility in the beta over time, up and down. So which beta do you use? Well, analysts often make the mistake of using a company's published beta or a beta that they've calculated. Now, these mistakes are the result, they often result in using either a too high or too low beta. But remember that you're estimating beta to infinity. Hence, you should be thinking about that and making sure that you are thinking about your beta being the future, not the past beta. So you can't calculate the beta ultimately. Now, a common mistake is valuing a stock using the calculated beta. And the point is that some people will use different data providers to get that. But the real mistake is to realize that valuation is made to infinity. Hence, your beta is a forecasted beta, and that forecast is to infinity. So, what beta should I use? Well, I started to observe analysts manipulating the beta to arrive at their derived values. As head of research, I started to see the risk-free rate for all the companies. I started to set the risk-free rate and give a range for betas also. I said that low-risk companies should have a beta of not less than 0.75 and a moderate companies at 1 and high-risk companies at 1.25. Now, we later researched this at my firm, and I want to show you this. We followed stocks over 10 years to see how the beta developed. The stocks were grouped into 5 groups, quintiles. And here you can see that the highest beta stocks were in the group that is represented by the red line, and that is 1.99. But when we looked at them over 10 years forward, we found that they fell, and they fell to about 1.2. And we can see that the low beta group had an average beta of 2.27, and they rose, but they still rose to not to the average. And this is why I choose 1.25 for the maximum beta and 0.75 for the minimum beta, because we're looking at beta going forward for many years. Now, our research showed that high betas fade down to above average and low betas fade up to below average. They don't go to the average. So you can use this research as a guide to help you keep beta in a tight range. So this is how my valuation masterclass students avoid mistake number 7. In fact, this is Jack Sheehan. He was a student in the boot camp, and he was a student in the live course. He really has a passion for learning. So they select beta within a tight range. So don't use a beta calculated from historic data. Instead, estimate your beta to infinity, but keep it in a tight range of 0.75 all the way up to 1.25. Now, if your forecasts deviate significantly from past or consensus, Ensure you're not making a common mistake. If you're not, you've got a story to tell, and great stories make great analysts. So now let's look at choosing an unrealistic cost of equity. We're almost done, and then I'm going to move into questions. So a common mistake by analysts is discounting future cash flows at an unreasonable cost of equity. That is a very common mistake. And what happens then is it's the most common method for calculating the cost of equity is the capital asset pricing model. Now, 3 components are needed to come up with this: the risk-free rate, the market return expectation, and then the company's estimated beta. Now, you'll notice I say the estimated because it's all future. This is the formula that we use for the capital asset pricing model to estimate the cost of equity. So let me tell you a story. One of my top valuation masterclass students told me he spent hours on the capital asset pricing model. He asked me to look at his methodology for estimating the future risk-free rate, the market return, and the company beta. His work on each factor was excellent and clearly took him many hours to complete, but its final cost of equity was 4%, which produced an extremely high valuation. So it was a mistake. So don't get lost in the details. Analysts often get lost determining the components of the cost of equity instead of focusing on the actual cost of equity and what the end result are, instead of focusing on those components. Now, if your assumption is too high, then the company's value will be underestimated. The big picture is this: the components don't really matter that much. What matters is that you arrive at the correct cost of equity. Choosing a high cost of equity is, let's just look at how this could work. The constant growth model is what I'm showing you here. And a company with a most recent dividend of $10, a growth rate of 4%, and a cost of equity of 6 would be worth $520. But if we just increased that cost of equity from 6 to 8, the value of the company would double. It's very dangerous in that left-hand side. If you underestimate the cost of equity, you're going to cause more trouble because you're going to think that that company is worth more than it actually is. So I want to introduce you to Yogi Berra. He was a professional American baseball player and coach, and he was an 18 times All-Star and won 10 World Series championships. But he was super funny, and that's what I like about him. He said something like, you can observe a lot by watching, but isn't watching observing? And he said, it's tough to make predictions, especially about the future. All predictions are of the future. Now, other things he said that I thought were funny is, I said, I really didn't say everything I said. And he said, when asked why he doesn't go to his favorite restaurant anymore, he said, nobody goes there anymore. It's too crowded. And he said, always go to other people's funerals, otherwise they won't go to yours. He was a funny guy. Now, Yogi Berra went to the pizza place and he ordered a pizza, and then he went to sit down and he decided that he would go back up and ask them the question, how many slices do you slice your pizza into? And they said 6. And then after that, he thought for a bit and he said to them, you better cut that pizza into 4 pieces because I'm not hungry enough to eat 6. Well, think about that for a moment. Whether that pizza is cut in 4 or 6, does it change the size of the pizza? Well, the same thing here with beta, risk-free rate, and the market risk premium. It doesn't matter how you slice it. The main thing is that you want to get the cost of equity right, the size of the pizza. So make sure you get it right. Don't get it too wrong. Don't get focused on all these little things like beta and risk-free rate. So resolve this by setting a range. Our research on historical average returns and cost of equity have determined a rough range for U.S. stocks. We estimate a range of cost of equity between 8 and 13%. Now consider using this range as a guide and adjust it up or down depending on the country and other things. Thailand is a little bit more risky, therefore I would adjust it up. Now this is how my valuation masterclass students avoid mistake number 8. Now this one is a picture of my good friend right here. His name's Derek Van Pelt. Nice to see that one. We did that one at a local finance company. Now they keep the cost of equity in a tight range. That's how they avoid the mistake. So a too low cost of equity can significantly overstate your estimate of company's value, and avoid getting lost in the components of the cost of equity. Instead, focus on getting the right cost of equity. The rule of thumb is 8 to 13%. Now, if your forecast deviates significantly from past or consensus, ensure you're not making a common mistake. And if you're not, then you've got a story to tell. And great stories make great analysts. Finally, let's get to the final one. Success doesn't last forever. It's unreasonable to assume that a company's profitability will remain high forever. ROIC is what we use, and it's net operating profits after taxes divided by the average capital provided by both debt and equity investors. Good times don't last forever. We want to fade that ROIC because they can't maintain it. So research shows that higher ROIC companies see their profitability fade toward the average but remain above. So a star remains a star, while low profitability companies see their profitability rise but do not reach average. Therefore, you should incorporate this fading into your forecast. Here's the calculation that we did looking at companies around the world. And what we saw was that the most profitable companies had an average ROIC of 28%. And the worst, the dogs, had minus 13.3%. And over time, we can see that they faded to either a premium or a discount to the weighted average cost of capital, or in this case, the long-term average. Now, the dilemma is that we do not have a consistent and reliable source of forecasted long-term return on invested capital for industries to fade that cost of capital to, or ROIC to. So instead, we use the company's WACC, the weighted average cost of capital, and it's a company's debt as a percent of total capital times the cost of that debt plus the equity as a percent of total capital times the cost of that equity, and there's the formula. So when a company earns an ROIC that's above its WACC, it is creating value, and if below, it's destroying value. Now, our research shows that the current ROIC premium or discount to WACC will not stay the same. So if a company has an ROIC that's higher than WACC, then consider fading it, but fade it not down to average, but to a premium. And if a company has an ROIC that is lower than its WACC, then consider fading that discount up over time. Most analysts overestimate the returns, and basically this is a common mistake. If it happens, you may buy that company's stock thinking it's more valuable than it actually is. Now, this is how my Valuation Masterclass students avoid mistake number 9. They fade ROIC to a premium or to a discount to weighted average cost of capital. So what have we learned in this section? Well, fade that ROIC to WACC and fade highly profitable companies to a premium and low to a discount. Now, if your forecast deviates significantly from past, ensure you're not making a common mistake. And if you're not, you've got a story to tell. And remember, great stories make great analysts. So we've been through all 9 of the 9 common mistakes. And before we go into Q&A, just to remind you that the next boot camp starts on the 25th of July. And the boot camp equips you with the skills required to work as an investment banker, asset manager, equity analyst, or become a value investor. Batch number 3 attendees identified 6 things that made their boot camp experience unique. First, they were transformed to be more focused and determined. Second, they learned everything needed to become a successful financial analyst. The third was they experienced a challenging yet supportive environment, and they gained advanced valuation knowledge presented in a simple way. They focused on the practical aspects of finance and valuation, and they enjoyed powerful and engaging teaching style, the type that you just saw. Now, I have a bonus. If you sign up within 48 hours, you're going to receive my Achieve Your Goals course, which is a $147 value. And satisfaction's guarantee. We have a 7-day money-back guarantee, no questions asked. If you find the boot camp is not for you, we refund your money 100%. For everyone on this webinar, you save $700, plus you get the bonus of the course if you join within the next 48 hours. Just use this coupon code when you do, and just go to valuationmasterclass.com/bootcamp or scan that QR code. So let's see if we've got any Q&A. I'm going to close the presentation, and I'm going to stop sharing and see what we got. Whew, that was a lot of talking, huh? It went fast. Let's see. So let's look at if we've got any questions. So here's a question that I see from Ann. Why should we forecast maintenance CapEx a little bit higher than depreciation? Because imagine that a company is not going to grow its revenue. It's going to keep its revenue stable. But they're still going to have to run their factory to produce enough to keep the revenue stable. When they're running their factory, they're running down their assets. And then what happens then is that they're depreciating. And then they must invest money to keep those assets up. So how much did they invest? They're going to invest a little bit. They're going to invest enough to maintain that asset, and that's the depreciation charge. So that's the reason why I say that depreciation charge is an accounting term where they say, okay, this is going to depreciate over time, but in real life it is depreciating over time, so you need to replace that. And there we go. Lee said, cost of equity specifically, try to estimate the equity risk premium. It's one area that I spent too much time on. The pizza theory really helped me. Yes, everything is better with pizza. I'm hungry now. Amit says, let's see, Alex, Sarah, something. Since we're always going to be wrong, which mistake is better, to overestimate or underestimate? The problem is if you overestimate revenue and you buy the company and it doesn't deliver that revenue, bad news, the stock price is not going to go up. In fact, it may go down. So underestimating and being conservative is better when it comes to your money. All right, if there's any other questions, you can turn on your camera and turn on your audio and ask them, and I'll be happy to answer them. It's 7 o'clock. I try to keep this webinar on time. That's part of the reason why I went really fast. If you've got any questions about the boot camp, about the valuation masterclass, or anything about 9 valuation mistakes, feel free to ask now. If you've got to run, no problem. We'll send a follow-up email, I think tomorrow, that will have the link to this so that you can watch it. All right, any questions? I'm going to say goodbye to you guys. Whoever wants to stay on for a few minutes, I'm going to remain. If you've got questions about the boot camp or anything else, just let me know. Alex said, yeah, we're going to email you tomorrow. All right, see you guys. Any questions, feel free to ask. It went fast. All right. Feel free to ask if you got any questions. I know most of you guys got to run, no problem. But if you got any questions, feel free to ask. Yeah, I've got a lot of experience. I love it. I just am devoted to this topic, you know. You're welcome. Good night. All right. I hear my mother walking with her walker, so that means she's walking to dinner. So I'm going to walk over there and join her. I'm going to turn off this webinar. If you got any questions, feel free to reply to the email that you get tomorrow. I'll see you guys later. And for those in the boot camp who are still here, I'll see you tomorrow night. Take care.